Hello and welcome to Bunnex Investment Group. Today we are going to talk about scaling into your trades, that is adding more positions to your initial one. It is a very important topic that is fundamental to your trading, as it is a technique that will make you maximize your chance to earn more. But before we go further, please make sure you turn on your notification bell icon so that you'll be notified each and every time I upload a new video. So the first thing that we are going to talk about is risk management. I've seen several traders entering several trades at once. These are the exact posts flooding the social media right now. Do not fall for it, as it is the number one reason why most traders can make $1,000 and cannot make $100,000. Everything that I teach is long-term investment, where you trade without fear, where you trust the process, where you sit back and know that trades are coming no matter how long you are going to wait. Normal trading is clusters of good luck and clusters of bad luck, that is losing and winning streaks. Both sides of the coin should find you on proper risk management. Otherwise, you blow your account on a series of a few losing trades. So we are going to jump into the rules of scaling. Before we go to the rules of this subject, you must remove the mentality of must win every trade to trading with probabilities. The first rule of scaling in is defining the move. This is a point you are going to anticipate how long the move is going to last. All the entry points that are going to be issued within that move. In our case, if you have caught the market maker peak, it means you are going to have 2 more entry points before the move comes to an end. This is a chart example. It was actually a snippet of GBP against yen, where I marked the levels from level 1, level 2, level 3. This was the peak on this pair, meaning that this was the point where we were going to enter our first trade. After entering this trade, we actually know that the market maker cycle moves in threes. That is, if we catch this peak, we expect at least 2-3 more days of rise from our peak. Therefore, our first trade was going to be on this level, which I labeled right here. Then we had our first level flow. After having that first level flow, the market traced to our anticipated region, which is the region of 61.8% on the Fibonacci retracement level 2. That is where we were going to enter our second trade. Then from that, since we have defined the anticipated move or the length of the anticipated move to be equal to 3 days of rise, it means this trade, the first one, was going to last 3 days, then the second one was going to last 2 days. That is what we mean by defining the move. The second rule of scaling in is position sizing check. When scaling in, the trades to be added should be equal to half of the initial size. I will repeat this again. When scaling in, the trades to be added should be equivalent to half of the initial size. This is to put yourself in lesser risk when the market starts going against your move. For example, your initial trade is 1 lot. It means your scale in trade should be 0.5 lot. Our third rule of scaling in is stop loss management. The initial position of your stop loss depends on the lowest price point of your entry day. This usually ranges from 30 to 50 pips. On your next point of entry, make sure you move your stop loss to entry price of the initial trade. This will mean the initial trade is now a risk-free. However, the scaled-in trade requires a stop loss, and you have to put the same amount of pips as those you initiated on the first one. After that scale-in trade moves at least 50 pips into profit, you have to put your stop loss on your price, on your entry price. On number 4, holding the positions. This is the most difficult period for many traders. To hold your positions in profit until the move is completed requires a lot of discipline. The forex market does not move in a linear way but jerks and intimidates. I'm sure you have ever come across a situation whereby you have 100 pips in your profit and the next hour you are 50 pips in loss. That is how the forex market, not only the forex market per se, it's actually how all the tradable markets, stocks, shares, bonds, commodities, each and every market behaves in that system. You must hold yourself from checking the market frequently, as it will definitely tempt you to act. You close trades prematurely, or you will start to add more position after having euphoria of thinking that you have actually nailed. On each and every trade, you must always think of loss first than profit. There you have it, the 4 ultimate rules for scaling in your trades. Thank you for watching, and before you watch your next video, be sure to check out our Free Signals Telegram channel, and this is actually the link in red. Just type it in your browser. You get this group and join. It will be helpful to you. And do not forget to check out some of our videos on this channel, especially the Market Maker Method summarized course. It will be helpful, and share with someone. It will definitely help another trader.